Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and 10-year note yields continue their weekly decline. Fourth consecutive week we've seen a decline in 10-year yields, and right now that doesn't seem to be seeing any sort of obstruction. It's going to continue to go down as long as it can. It is still holding that 280 to 290 range, but right now the market sees something a little different, I think, than what economists and Fed watchers are seeing, and that is that long end rates should be a little bit higher, and they're not. They're continuing to trend lower. So we hold that trend. Technically, we're still looking at a bull trend in price, a downtrend in yield, and it doesn't look to reverse. Obviously, that can change very quickly, but right now, given all the news we've had, all the talk of trade wars and tariffs and anything going on geopolitically, it hasn't reversed this recent trend. So right now, the yields continue to decline. And as we're staying in that trend, and as yields continue to decline, market volatility continues to go down as well. We did see a little bit of an uptick, but nothing that would cause any sort of angst or fear. It was more of a midweek uptick with minutes and non-farm payroll this week, and those were two events that came and went. And so right now, the selling continues in implied volatility. So implied volatility after a modest uptick, getting sold, going lower. We hold that trend in yield wise. And let's talk about the jobs number. On the surface, yeah, we had 200,000 plus new jobs. The average hourly earnings were a little bit of a disappointment. The unemployment rate upticked slightly. But really, if you peel back the onion here, all those jobs that we saw that were brand new were all part-time jobs. So it really wasn't, there were no full-time ads there. That's really going to be key here. And given the weakness in the average hourly earnings, which is really the key component that we watch in the jobs numbers now, because new jobs haven't been the problem. The payroll numbers haven't been the problem. It's been the inflation component, which is the wages that we haven't seen. Yeah, they've been trickling up higher, once in a while, but we haven't really seen a sustained pop that would cause the Fed to act more aggressively or would show that there's going to be higher wages down the road. So right now, the jobs number was kind of they're calling it a Goldilocks number, sort of warm. I think given the fact that wages were weak and the jobs themselves were part-time, not full-time, suggests that the economy may not be as strong as the headline suggested. So again, another reason why yields will continue to decline and probably hold that range. But if we break below 280, in the 10-year yield, that's going to bring in some buyers with both hands, and that could bid volatility, and that could kind of change the landscape here, as uncertainty is the only certainty as we move forward, and the bond market is telling you that, not only with the flatness of the curve, but with the declining yields. This is Todd Colvin coming to you from the floor of the CME Group.